This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to another episode of Value Investing. This is episode 39. Over the last 4 episodes, we talked about mainly 3 topics related to Philip Fisher. First, we talked about how to identify outstanding growth stocks. And Philip Fisher laid out 15 points that you can go through in order to find outstanding growth stocks there. And second, we talked about when to buy stocks, when it's the right timing, and so on and so forth. And lastly, in the last episode, we talked about when it's the right time to sell your stocks. So I think it was a really great lesson for a lot of listeners and also for me, obviously, because I read this book called Common Stocks and Uncommon Profits by Philip Fisher, and I personally learned quite a lot. And this is my second time reading this book because I had to do the podcast and I was capturing a lot of good points from Philip Fisher. I was able to refresh my memory and I learned quite a lot. I hope that it's basically the same thing for you. The reason why I'm focusing on Philip Fisher at this point is because I was interested in Warren Buffett first, and Warren Buffett once said that Warren Buffett is basically 85% Ben Graham and 15% Philip Fisher. So Warren Buffett was influenced heavily by Philip Fisher, who was unknown to me at that time. So I wanted to know everything about Philip Fisher because Warren Buffett praised him a lot. So I purchased this most famous book by Philip Fisher, Common Stocks and Uncommon Profits. And I'm going to put the link in the show note. So if you want to buy this book, you can go there and buy from Amazon. I think it's approximately $15 or less. So it's quite affordable. I think that it's really enlightening in many aspects because he's categorized as growth investors, as opposed to a lot of other legendary value investors like Warren Buffett and Peter Lynch. So he's not a value investor, but you can glean a lot of lessons from this book. And that's why I'm covering a lot of contents within this book over the course of 5 to 6 episodes. So today what I want to do is cover a chapter that talks about common mistakes that investors are making. So I'm so excited to go over 5 common mistakes investors are making. And Philip Fisher laid out his reasons why they are not good for average investors. So before I get started, let me just give you a quick disclaimer that this podcast is for entertainment purposes only. And it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get into actual topics? So as I mentioned in the intro, let's just go over 5 common mistakes Philip Fisher identified within his book. First common mistake: don't buy into promotional companies. What Philip Fisher means by promotional companies here is the ones in the early stage startup or the ones without any profits. So let's think about what it means by successful investing. Successful investing requires finding companies which are developing new products and processes or exploiting new markets. That's the definition of successful investing by Philip Fisher. Based on that definition, at first glance, young companies not earning a profit on their operation may appear to be of investment value. So why not buy this company when the first shares are offered to the public before someone else make all that money? However, there are problems to this approach. That's what Philip Fisher said. The problem is, a company without at least 2 or 3 years of commercial operation and 1 year of operating profit should be put into a completely different category. Because investors did not have a chance to observe the company's production, sales, cost accounting, management teamwork, and all other aspects of its operations. All the investors can do at this point and at this stage is to look at the blueprint provided by founders and guess how the business would operate in the future. So it's more of guessing game than analyzing the company. It is so difficult to do that no matter how skillful the investor is, and it makes it impossible to obtain even a fraction of the batting average for selecting outstanding companies. All too often, young promotional companies are dominated by one or two individuals who have great talent for certain phases of business procedure but are lacking in other equally essential talents. And these founders may be good salesmen but lack other types of business ability. So for these reasons, Philip Fisher thinks that their financing should always be left to specialized groups such as angel investors and venture capitalists, because such investors have the management talent and expertise available to bolster up weak spots as unfolding operations uncover them. I haven't really had any chance to invest my money in startups, so I don't have the first-hand knowledge or experience in this area, because I feel that without any financial statements, I just don't know how to assess the company's value. And I watched TV show Shark Tank. I think this is one of the most popular TV shows out there related to business. And I quite enjoy watching that. But if I just watch the show and if I see a lot of founders presenting their ideas to these sharks, I just don't know how to evaluate that company and I don't know how to make the decision. If I have tons of money and if I can spread out my investments across, let's say, 1,000 startups, maybe it's going to work out because a few of them will be super successful and a few successful investment will maybe outweigh all the losers in this market. But if your pure focus is to find a few outstanding companies, and if your investment style and portfolio management style is to concentrate on a few outstanding companies, then this is not the right type of investment vehicle that you want to get in. So diversification, I feel, matters more here than concentration. But I'm type of person who concentrates my money into a few number of stocks. So I tend not to get into this field, as Philip Fisher mentioned, because I just don't have knowledge to assess future profitability of the company. If you don't have any financial statements, then how can you assess the future profitability of that enterprise? So I completely agree with Philip Fisher on this point. It has to be left to specialized groups and specialized investors like venture capitalists and angel investors. So that's the first mistake that you might want to avoid as an average investor in the market. The second one is don't ignore a good stock just because it is traded over the counter. Again, here, I'm not the expert in buying stocks in the OTC market, so I'm not going to chip in here. But I just want to mention one thing related to illiquid stocks. Because a lot of institutional investors don't invest their money into illiquid stocks and OTC stocks. So whenever these large investors avoid certain sectors, not because of investment merit, but because of their restrictions on their fund or limitations that they have, I think it's going to create great opportunity for small investors. So I'm not at all against investing in OTC market or illiquid stocks. As a matter of fact, I invested my money in some Korean stocks in the Korean market, which are quite illiquid. So if I have $100,000, I can completely change the price I can just drive up the price within one day. It's quite significantly more than 5%. So the stock is quite illiquid. But still, it is a great opportunity if I understand the company and if I think that the future prospect of this company is good. And it doesn't matter whether the stock is illiquid or not. As long as I can accumulate a certain percentage of my portfolio with this stock, successful buying at low price, then liquidity doesn't really matter to me because I put my money in the long term. But traders wouldn't want to actually get into this area because that's going to cost them a lot. If they want to get in out of the market quickly, then illiquid stocks probably are not their friends. So that was the second mistake, and I didn't really talk details from this book by Philip Fisher because a lot of content within this area seemed to be outdated because this book was written probably 50 years ago, and he was talking about brokers and dealers, and they may not be applicable right now. But high level concept is still applicable, which means if you find illiquid stock, and if it's outstanding company, don't hesitate to invest your money there because if you put it in the long term and if it's truly outstanding company, then your reward is going to be actually very high compared to liquid stock and large cap companies. Let's move on to the third mistake that investors are making. Don't buy a stock just because you like the tone of its annual report. I completely agree with this point as well. Investors are not always careful to analyze just what has caused them to buy one stock rather than another. They might be surprised how often they were influenced by the wording and format of general comments in a company's annual report to shareholders. So there's no way of telling whether the president actually written the remarks in the annual report or whether a public relations officer has written them for president's signature. There's usually attractive photographs and nicely colored charts, and they do not necessarily reflect able management team working in harmony and with enthusiasm. So Philip Fisher said that allowing the general wording and tone of an annual report to influence a decision to purchase a common stock, it's much like buying a product because of an appealing advertisement on TV. The product may be as attractive as the advertisement, and it may not be. And usually they are too optimistic. So whenever I look at annual report, I don't look at shareholders letter first. I just go directly into financial statements and try to understand business performance first, and then come back to the first page, which is usually the annual letter to shareholders by the president, and see if there's consistency between what the president is saying in the letter versus actual performance. Because even if performance is mediocre, these CEOs have a tendency to say that the performance has been outstanding this year. I don't exactly know why they do that. It's maybe for marketing. It's just to convince investors to buy more of their shares. But they are very, very optimistic in that regard. So the bottom line is take annual shareholder letter with a grain of salt and just be critical whenever you read shareholder letter from the CEO or the president. Let's move on to the next mistake that a lot of investors are making. Don't assume that the high price at which a stock may be selling in relation to earnings is necessarily an indication that further growth in those earnings has largely been already discounted in the price. So Philip Fisher is here saying that the market may not be efficient in terms of pricing stocks in the market. So let's take a fictitious company and we might call it XYZ Corporation. And this company is qualified for years in regard to the 15 points that Philip Fisher discussed in his book. And now it is sold for 20 PE ratio, price to earnings ratio, when the market average PE is 10. Just from the perspective of P ratio, this company is selling twice as much as the market in terms of valuation. The management just issued a forecast indicating the company expects to double earnings in the next 5 years. On the basis of the evidence at hand, the forecast looks valid. So with all that said, many investors would jump to false conclusions. That's what Philip Fisher said. And a lot of investors would argue that since XYZ Corporation is selling twice as high as stocks in general, and since it will take 5 years for XYZ's earnings to double, the present price of XYZ stock is discounting future earnings ahead. And they might say that the stock is overpriced. The fallacy in their reasoning, Philip Fisher said, lies in the assumption that 5 years from now, XYZ Corporation will be selling on the same P ratio as will the market with which they compare it. If this company is an outstanding growth company and has been selling at twice the P ratio compared to market, then it is fair to assume that the same company would likely be selling at the same P level 5 years from now, which means that the price would double along with doubling of its earnings. And that's kind of the argument from Philip Fisher. If this is still outstanding company, outstanding growth company 5 years from now, it deserves the same P ratio, which is 20. And if this company keeps the same P ratio from 5 years from now, and if it doubles earning, then the price is going to double. Philip Fisher asks you to look around and see how many sophisticated investors get themselves crossed up on this matter of what P ratio to use in considering how far ahead a stock is actually discounting future growth. If the company is deliberately and consistently developing new sources of earning power, and if the industry is the one promising to afford equal growth spurts in the future, the P ratio 5 years from now and 10 years from now in the future is sure to be as much above that of average market as it is today. This is why some of the stocks that at first glance appear highest priced may be the biggest bargains, and that's what Philip Fisher said. I think you have to think about it yourself, because a lot of value investors resist buying high P ratio stocks, and I'm one of them. However, if you're for sure with some degree of certainty that the company's future earnings would increase a significant level, even if the stock has high P ratio, it might be a good buying opportunity. For example, if you're trying to buy a stock which is in cyclical industry, usually high P ratio indicates that the market is about to rebound. And when you're making decision whether to sell stocks because of high P ratio, my recommendation is keep them in your portfolio, and that's what I do, because it's not really easy to buy outstanding companies at low valuation. So once you buy outstanding companies at low valuation, just try to buy and hold. That's just my style of investing. So let's move on to the last mistake. Don't quibble over eighths and quarters. And for this explanation, Philip Fisher used an actual example. He said in a book, a little over 20 years ago, a gentleman wanted to buy 100 shares of a stock listed on the New York Stock Exchange. On the day he decided to buy, the stock closed at $35.50. On the following day, it sold repeatedly at that price. This gentleman put his order at $35 and refused to pay additional 50 cents. The stock never again sold at $35. Almost 25 years later, the stock is now selling at above $500. In other words, in an attempt to save $50 on 100 shares, This investor failed to make at least $46,500 from his investment. This particular example is by no means an extreme one. That's what Philip Fisher said. Philip Fisher on purpose selected a stock which was more of laggard than a market leader. So there's a balance between the risk of not being able to fill out the order and the risk of paying too much. And this is what you probably would face every time you're trying to buy some stocks. So over a long term, Philip Fisher is emphasizing that the risk of not being able to fill out the order is significantly high if you find the right stock to invest. Philip Fisher has some advice for small investors and large investors. So for small investors, average mom and pop investors, just do the market order. That's what Philip Fisher said. Unless the stock is illiquid. But a lot of stocks on New York Stock Exchange are mostly liquid stocks, so you don't have to worry about driving up the price by your order. So if you have small amount of money, then you don't have to worry about liquidity of this stock and just buy at market price. And Philip Fisher also had advice for large investors who could drive up the price if they are trying to do the market order. He said that give your broker or securities dealer a completely free hand on price up to a point somewhat above the most recent market price. On this point, I think I'm with Philip Fisher whenever I go out and find a company that are selling below intrinsic value, and if the margin of safety is large enough between intrinsic value and the current market price, then what I do is I place market order unless the liquidity is very, very tight, which I mentioned that in some cases for Korean stocks. But usually whenever I buy stocks in the US, it doesn't happen frequently. So I just place market order. So my main objective is fill out all the order that I placed and accumulate significant position in my portfolio whenever I find great opportunities. Okay, so that's it for today's episode. So we talked about 5 common mistakes that a lot of investors are making. And Philip Fisher mentioned those mistakes in his book, Common Stocks and Uncommon Profits. So let me just quickly go over them. First one is don't buy into promotional companies like startups. Second one, don't ignore a good stock just because it is traded over the counter. Third one is don't buy a stock just because you like the tone of its annual report. Fourth one is don't assume that the high price at which a stock may be selling in relation to earnings is necessarily an indication that further growth in those earnings has largely been already discounted in the price. And last one is don't quibble over eighths and quarters. I hope that you learned quite a lot from this episode. It was quite interesting one, and I'm gonna probably make a couple of more episodes with respect to Philip Fisher and move on to a different topic in the future. Before I end, I just want to say that please leave your comments, reviews, rating on this podcast, wherever you listen to this podcast. And it's going to help other people to find this podcast. And as you know, this podcast is free. So that's all I'm asking. Thank you very much and see you next time.